Welcome back, everybody, to 21st Century Renaissance and to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. Yesterday, right, not necessarily super exciting of a day, right? Look, maybe early on, we got that little bounce, the 200-day SMA over on GameStop. Looked like we were going to recover with the broader market, and then, surprise, get dragged diagonally down and to the right. Kind of a second day in a row of teleportation like that. So, yeah, despite seeing that, I mean, right, we'd say like, okay, that's that is largely consummate, maybe with some of the things we'd expect from transition between volatility cycles, but yet we have IV cranking up. So something is going on there. So we're going to think about that a bit today. As well as take a look at our usual data over in options and over on our technicals. And think about what that will mean for our trading heading into today's trading day. So before we get started, head on over to do our little show of gratitude there. Always important to show some gratitude, right? Everything we do here, completely open access, completely open open access, no paywalls, nothing like that. But many folks out there are generous enough to go ahead and express their appreciation for the work I do here over at 21st Century Renaissance. So today's thanks go out to, I think this is like Have. I'm going to guess it's a Dutch name. If you're Dutch, Have, thanks. But even if you're not Dutch, also thank you. Thank you for sponsoring today's newsletter and today's video, as well as thank you as always to our monthly supporters, Dat Scruffdo and Ken Winmerland. Thank you very much. Both Scruffy and Ken generously pledged to help offset some of my data expenses on a regular basis. So thank you very much. Thank you very much to everyone who has supported in the past and is continuing to support the channel in now and in the future. So thank you very much. Really interesting post I wanted to take the time at the beginning to point out here. Have a look at this if you hadn't had the chance yet over on Superstonk. It's by What Can I Make Today? Really like What Can I Make Today? What Can I Make Today is another one of those Reddit users who still puts out quality content, things that are worth thinking about, right? That is always how I judge content. Does it bring an angle to the discussion? Does it bring some insight, which whether or not it may be true or whether or not it may actually end up playing out, what does it bring to the table in terms of how can it help us think about this problem? How can it help us approach this question of what's really going on a regular basis? Can we get this model of how GameStop's price action works better? So what can I make today with some contributions to that, suspecting that, yeah, maybe there was something that went down with these Citadel Securities bond sales back around the time of this January 13th or 13th through 15th kind of sell-off, right? That what is suspected here, and it's something I sort of commented, it's something Richard Newton commented on a few days ago, the idea of this pertinent perhaps to swap rolls, but also these particular days, these rhyming days versus 2021 in particular are days where something perhaps might have happened this year, and there have been new tricks perhaps that have been taken out of the bag to make sure that these days in particular did not end up being as much as would have been hoped for or anticipated. It is interesting to see that, right? A lot of people were looking at January 13th. I was looking toward January 15th in particular as sort of the Wednesday before OPEX, but many people were looking into that range as, right, like I said, myself included, as a particular, kind of rhyming date for the 2021 sneeze, right? That was when the really explosive exponential upward price action started to occur back in 2021. And of course, 2021, that was fateful. But this year, instead, we kind of got the same type of movement down, though, right? We had all of this short volume materialize kind of out of nowhere. Short shares materialize, filled up the lend pool in the few days leading up to this, after this, the market closure on January 9th, where settlement was allowed to take place. And yeah, then right, February 24th here, 21st into 24th, things were looking really good in terms of momentum. Was looking like technically we had some more up, some potential room to continue with the up move that had started, yeah, really earlier in the week. Really toward the end of the week, but then had begun earlier in the midweek. We got a really strong signal on swap movement per some of Altimeter's indicators, and then all of a sudden, 21st, after looking good early, we just started moving straight down into the close for a max pain finish at 26.50, and of course yesterday, right down exactly to $25, despite the fact that, yes, it did look like we were in for some potential more upside heading into the beginning of the week. Now, of course, we see a lot of news reports trying to correlate this with SPY and a broader market sell-off. I mean, is that necessarily the case? I mean, if we scroll down and we look at SPY, we look at the S&P, well, sure, right? If we take a look, we make that comparison. Early on, certainly, we have this V-shaped recovery, this kind of sawdown, and then kind of a bounce back up, right? SPY bounced back up right over the volatility trigger there, and then hung out right on top of it for a good portion of the trading day. And if we go look down at GameStop, right, we'll double back to this stuff in a bit, right? Okay, we see a lot of that. But right at about 145, right? So right about 145, SPY bounced off. It did not cross below the volatility trigger. It stayed above that line. It stayed actually well supported above that, above VWAP, really much closer to what would have been closer to 3. And then it traded down a little bit, but really didn't go into anything of a sharp decline until maybe minutes before the close, when it kind of violently went down. It had broken through the volatility trigger and then went down to about 597. That's not what GameStop did, right? GameStop was trading pretty lockstep in with SPY until 145, when it just started moving diagonally down and to the right, right? That is not, right? This looks very similar, right? This formation, very, very similar to what was going on with SPY. This looks like, ETF outflows or something like that, selling shares based on what was going on in the broader market. This does not. This pattern is not consummate with what we saw. Okay, yes, the price declined a little bit, but not to the same extent that GameStop did, right? So this immediately makes me think, right, and especially look at the pattern on the day, right? VWAP ends up in the same position, and where the price is trading ends up kind of lining up, right? We get a cross above VWAP, cross above VWAP here. We're slightly below VWAP on this kind of squiggle mark, a little bit lower here, but right above these marks, and then divergence right around 145, especially with this type of order, right? We see that low volume uptick. What was that, man? What was that volume uptick right there? What happened? Not sure. But this type of movement, right, makes me think, okay, someone put their finger on the scales to go ahead and make this happen. Especially conspicuous was the price ended exactly at $25 on the day. Anytime it ends exactly at that mark. It's not impossible, but coming off of something that looked rather engineered was a little suspicious. Now, I mean, that's all I can say at this point in terms of, what I was, the things I look at on a regular basis. Did not take a fine-tooth comb to go see if I could find some conspicuous orders here. What was very strange, of course, looking at this, was what ended up happening was shares available to short went up. So this was not caused by direct shorting on GameStop, right? We saw them go up. They ticked up. They were 2.7 million pre-market, and somehow with the price going down that sharply, shares available to borrow went up. Now, what I would say is the most kind of perplexing element here for me, though I do have one kind of leading thought on what this might be, is the degree to which implied volatility actually continues to move up. So here, right, we've talked about these volatility cycles, right? I'm certainly informed on the function of these volatility cycles based on how I understand Reddit user Gherkinit's DD when the river runs dry DD functions. It's been pretty useful in terms of understanding the types of price action cycles that GameStop's been going through, basically up to this point. It's been very useful. It was very useful basically up until, to predict fluctuations in IV with respect to price, basically up until a few weeks ago, really right up until this kind of price action. And I would say, right, what's supposed to happen is when liquidity comes up, volatility goes down. So as price goes down, yes, sometimes the liquidity can go up, right, which is what we've seen as funds go out and close FTDs and replenish ETF stores and things like this. So this is not entirely a head scratcher to see the price trade down like we're seeing here, like we saw here late in the day the other day. That's not unusual, but then to see IV, okay, yes, it did briefly come down, but then it ticked up, and now heading into today's trading, we're kind of back around 85% after kind of hitting a low of 82 early, right? So that's typically not what we see on GameStop, right? We've seen it tick up, and it does not look to be ticking back down anytime soon, despite the fact that the price is moving up. Or excuse me, the price is moving down and liquidity is increasing. The one sort of explanation, although I will say that this has looked to me this was looking to me to be a bit too far out to be tracking kind of anticipatory earnings elements. I mean, we can take a little closer look. Why don't we do that together now? I was thinking about this, right? We do have a lot of chop in here, kind of in our, this bullish uptrend in the beginning of January, which looks a lot more like 2022. But if we compare some of these more, how would we say, regular earnings IV appreciation cycles, I suppose if we take a look at last year's Q4 earnings, in late, well, basically throughout all of February, we got IV to tick up last year. Not a lot, but, over on our 10-day mean implied volatility, we are significantly lower than that at this point, I will say. So basically, late February, on our mean implied volatility, we were, around 70, 80, something like that into early March, 80, and then really kind of, once we got to within that 2-week range of earnings, we really started moving up despite the fact that the price did not. All the way up to the day before earnings itself, where mean implied volatility got up to 212%, which is ridiculous. And then the price, of course, sold off very dramatically. So we're way down. We're way down around 40, 50, 60, but slightly kind of ticking up. Maybe we do that, right? Maybe because this is annual earnings or something like that, we're not looking at a 2-week. I mean, I imagine that if this is the case, still the most pronounced IV appreciation is going to be settling in around the 11th or the 12th of March, depending on when earnings actually are, whether they be on the 25th or the 26th. Those 2 weeks, as we can still see here, right, for last Q4 earnings, those are still going to be the most profound. But we did basically throughout late February see IV kind of tick up a very little bit, and then into early March, it did actually start to tick up, even though we didn't see very much in the way of anything price related. So because this is Q4 earnings, what this is this might already be the effects of that anticipation starting to take effect. It is just a little surprising to see it this far out, right? So more than 4 weeks, or exactly 4 weeks out from earnings, to start to see that kind of bubble up underneath us. Again, despite the fact that we are moving down so strongly, and we see short liquidity increasing. So something to keep in mind, something that certainly stands out to me. And that I was not necessarily expecting, or would not expect from this type of price action. So a little bit of an enigma for me, something to keep in mind, something to keep sort of in the back of my mind as I look at stuff, but be interesting to see how that develops. If we look at broader market context, right, again, some of our price action can actually be explained based on how closely it resembled what was going on in a broader market, especially in the first half of the day. I think a lot of our price action can be explained by what is going on in the broader market, which, been talking about this, especially part of the reason I developed this, develop my kind of market context look here on the newsletter is to point out, hey, when we might be at risk of some kind of event like this, by understanding when SPY may be in, SPY and SPX may be in jeopardy of running across their volatility triggers. So this is when IV spikes, meaning it's a move down that crosses over a particularly large trader long put gamma position, which brings about a lot of increased implied volatility due to the fact that as the price moves down, traders or institutions are going to sell shares and kind of add to the momentum as the price moves down when they're in this type of environment. And they're going to buy shares as the price moves back up. So what you're going to see, and you do see this over in the charts, right? When you move into these negative gamma zones, these trader long put zones, trader long put dominant gamma zones, right? You see the price kind of zigzag up and down. It kind of whipsaws because you can get, right, as traders go ahead and spend money in the market, as options traders commit capital to short-term bets, to trading contracts, this influences hedging flows to the extent that it's going to have a much more profound effect on the daily price action at a dollar per dollar basis, right? So if you're in a call gamma trader, long call gamma dominant area, it's going to be the opposite, right? So gamma hedging is going to work contrary to options momentum. In a put gamma dominance scenario, it's going to work sympathetic to options trading momentum, to options flows. So that's the environment we're in now. And unless we really kind of move definitively back up to kind of over that 605 level over in SPY, maybe 603, 604, but 605, the 6050 level, 6060 kind of over in SPX, we're not going to see that same level of stability. So definitely we do see traders adding to their put positions here. That's what they did. Going into today, we're not seeing profit taking yet. We maybe saw a bit of that midday put profit taking, but what does this say? This does put GameStop within a bit more of a vulnerable position with response to ETF outflows. Now, we have had 2 whole days now of pretty strong S&P sell-offs. I did spend some time talking yesterday, and in the newsletter especially, I would recommend you go check out yesterday's video. Go check out yesterday's newsletter as I got into a deeper sort of what would I say? A discussion. Right? I looked at especially Roaring Katie's price momentum oscillator within the context of the S&P 500 rather than just solely GameStop, to try to gain some insight as to what might be happening, what we might expect in SPY over the next couple months, as a way to try to understand what might be moving traders and major institutions to build out put positions to kind of have this pretty bearish outlook heading into March, which still looks to be in place. So is this the beginning of that type of correction? Are we going to see a quick bounce back to the upside? Are we going to return back to positive gamma territory? I can't say at this rate. I can only say that, or at this point, I should say. But I can say that moving into today, we would have to go in order to see those conditions restored, and it doesn't look like we're positioned for that kind of just yet. That doesn't mean we don't kind of get these intermittent recoveries right back to the upside, but just that it doesn't necessarily mean that when we do get those, that the risk is off. So just pointing that out, right, and that might also be true for some of the price action we end up seeing on GameStop. Yeah, shares back up. TA, right? Okay, right. If I were just looking at this, if I were just saying, okay, what does it really look like is going to happen if we're zooming out? We're looking at what GameStop is doing from a TA perspective, right? This 200-day moving average that we've seen going all the way back to last May has been a very deep support. It held up a few weeks ago when we bounced off it. So that would have been, I think that would have been 2/7, the 7th of February. So 22 days ago, we had we moved down there, kind of hung out right on top of it when it was down in like the 2450 area. And then, of course, the following week, we ended up really moving aggressively back to the upside. Big move on that following Monday, the 10th. Really big move after hours up to 3166 on that Thursday. That would have been the 13th of February. So whether we get something like that now, from a technical perspective, it would suggest yes. But what's really driving this price action in the first place? Ultimator seems to think that in part of what we looked at, the past couple weeks was driven perhaps by swap activity. And if that's the case, if a lot of that upward momentum is driven by swap activity, then that's not something necessarily that many buyers have control over. Is that swap activity corresponding to TA? Do swaps behave according to TA? I really couldn't tell you. But then to look at our price action now down to the downside, to see some of that price engineering down to this $25 level on the nose yesterday, right? If that can happen, is that going to be something respectful of technical analysis? Right, it does call a lot of this into question when we see these types of moves, right? Just like we saw all the way back at the end of, or I should say mid-January, to see huge move, no news, TA basically looking good, right? To see that come down also on discordant levels of volume, right? So just, in general, the past 2 months in GameStop have been, what is going on is the only thing I can say. TA, right, looks to form up. We get these kind of technical paradigms building up, and then something happens and we just teleport out of them. And then we're looking good, we're forming up a technical paradigm, and we teleport way out the top and then come back, and then we teleport way down out the bottom. Like what, hard to really put too much stock in the precision of what technical analysis can offer under these conditions. So it's really, really worth taking that into account. I can't encourage that enough. Right? I mean, this isn't trade advice in general, but with myself especially, like I am really reticent to take too many trades based on what I would normally understand, like what was working beautifully through all of our bull trend, with the exception of the shorting on, what would this be, December 11/29, excuse me, the 29th of November and the 2nd of December, right? With kind of the exception of that, a lot of really excellent technical plays to be made. Right now, not so sure, right? Not a lot of easy confidence to put in too much kind of intraday or kind of intra-week swing trade type stuff. Very difficult to pull off given the uncertainty of what is going on with the stock at present. So yeah, we did get this sort of momentum crossover. We were pretty close last Friday. This was something to be excited about. Going into last Friday, we were very, very close to a bullish crossover of Roaring Kitty's PMO on the daily chart. Looked like we were going to get that crossover. Actually, it looked like we were going to get that first off. It looked like a lot of different PMO crossovers were going to line up, all stack up on top of each other, combining with the daily crossover, and we were looking like we were going to have a pretty bullish day. And then a lot of those got shut down unexpectedly, starting at around basically at noon on the nose on Friday. And then, of course, yesterday's price action prevented that cross again from taking place. If we had moved $1 or maybe $1.50 to the upside, something like that throughout the day, I think the close would have done something. I think that would have indicated. Projected something like a bullish crossover. So who knows if this matters? Maybe this is something that institutions are attempting to prevent from building momentum. Maybe this is something they watch to try to prevent that. So hard to say, but just again pointing out what I'm seeing. Options wise, things that are short term here. looking good, right? Actually, a lot of these OI expansions or retractions were pretty bullish. So the $30 new calls over 2,000 were net at the ask, so bullish. 28s net at the ask, so bullish. 27 and 26 were bullish. 26.5 was bullish. 27 and 26, I think, were a bit mixed. And then the retraction, somebody retracted OI heading into today's trading at 24. So took 1,400 puts off the board at 24 at the bid, right? So those were trader long puts that somebody said, this is it. This is what this insurance was for. I'm cashing these out, taking my profits. Interesting to see that. We did have a good number, about 1,900 calls that were sold at $30 for March OPEX. I think they're for March OPEX. Right? No, for next week. For next week, 3.7. Otherwise, really not too much in way. But again, options activity was light. Yesterday's move was not primarily driven by options activity. Very little of yesterday's movement was driven by options activity. Which of course is always another thing that, if I see these big moves and then I don't see big movement, right? I don't see people betting on this in the options market, right? That's the thing. That was a big move. That was a sell-off of $1, almost $1.50 in the span of an hour, 2 hours, not even 2 hours. And most of this, okay, yes, very heavy bearish premium skew in terms of premium, but it's not a lot of premium. That's not a lot of options contracts that were traded. And a lot of this was concentrated in stuff way out, a lot of this premium. Stuff that was up close. Pretty normal and skewed bullish, interestingly. So pointing that out right in our, not enough to really change our max pain, which is still sitting at around 26. And then our stuff basically heading into March too. This chart exchange has 26.50 for this week's expiry. Maximumpain.com has 26. March 7th, 26. March 14th, 26. March 21st, OPEX, right, 25. It was 25 in February until it was 26.50, right? And then March 28th is at 25 right now. So none of this is like super bearish. And then April 17th, even April 17th is at 24 now. It keeps moving up. So none of this is crazy bearish. I mean, it's not amazingly bullish. I'm not saying like, come on, it should be pumping. Like, no, not necessarily. But does this really say, at least from what I'm seeing right here, like, oh man, it's really going to sell off? Like, no way. And I have seen that before, right? We have seen that. We did see that like all the way back in July. It was very obvious when that was going to happen. Quarter two earnings. It was very obvious when the stock was going to sell off, right? We saw all kinds of bearish options activity, basically ahead of the late July and August sell-off. Like that, we could spot options, bearish options. We could spot put gamma building up weeks in advance. That was very obvious. That's not what we're seeing here. So, I'm hard pressed basically looking at this data to all of a sudden go like, oh man, we're just going to free fall into nothing, like, oh, time to reposition, like panic sell or something like that, right? Obviously not trading advice or investment advice in general, right? But you know what I'm saying, right? Like that's not necessarily what's here. And despite the fact that we're having this stuff, like traders are not trading on this price action so much as they are trading on continued signals that say price go up, or at least it's going to be range bound. Not necessarily continued bearishness. Now, does that mean that continued bearishness can't happen? No, it definitely can, right? We're looking at that type of stuff take place, that the institutions, powers that be that do have the price to engineer this type of price action, they can do this and make this happen, make this materialize over short periods of time like this. Now, there might be consequences to that down the line that then are, somewhat difficult to predict. Maybe certainly there are people out there that are far, far better predictors of that type of price action than I am, that have some tools or design tools to try to find out how to detect those things. But with that being said, right, certainly from my standpoint here in the data that I'm looking at, it's major major continued bearishness, right, continued downside does not seem to be um, on the menu right now. Just putting that out there. If we do move down, and we could, right, we do have weakness below 25, right? We've stopped kind of right on top of 25. Pre-market now, we're kind of a few cents below 25, 24.98, something like that. Maybe starting to move back up as SPY's kind of recovering a little bit pre-market. We did move down to touch like 24.84, I think, very early in pre-market trading. So if we do get more shorting like yesterday, if that does emerge for a third day in a row, which maybe not, right? I mean, I don't want to rule out these scenarios because, right, I'm not looking at these institutions' books. But if it does, right, we could slip down to 20, wouldn't be much resistance. They'd get some support actually, right? So that kind of pick up momentum. If they decided they wanted to short it, if they wanted to use ETF outflows, like we could slip down to 23.50. Right around 23 is where we have we have the 50-week moving averages down there. If that ends up mattering to the institutions who continue to kind of just put their thumb on the scales, because that's what this is, right? Thumb on the scales. That's what it really seems to me. Right, they can kind of get some slip and slide action down here, but at the same time, if they just decide like, oh yeah, we only wanted to take it to 25 for whatever reason was important to us at the time, we'll just take the thumb off the scales right now. I would see this pretty quickly kind of shoot up back into the 26.50 area where it would have a little bit more stability here. With 27 functioning as kind of a near-term lid that would, of course, serve their interests insofar as kind of walking the stock back down to 26 or 26.50 by the end of the week for a max pain finish. Definitely don't want to watch. I imagine they don't want to see those 28s, certainly not the 30s, but see this large, some of this heavy call gamma accumulation up here around 28 or even 27. Go anywhere near to closing in the money by the end of the week. So, right, so put gamma, trader long put gamma just as it works sympathetically with options activity as the price moves to the downside through it. It works sympathetically with options activity to the upside through it. So you have upward volatility when moving up through this, and you have more downward volatility when moving down through this. So it goes faster. It kind of works like a hockey puck is the image spot gamma uses sometimes. So we'll have to see what happens. Those are kind of the properties. That doesn't include things like externalities, doesn't include things like, is there a settlement thing coming? Is there a swap thing coming? Is Roaring Kitty gonna, I don't know, tweet a fart? Like, I don't know, man, right? Like what happens when that, then somehow like that stuff ends up caring about like technicals, and then it goes back to not when it's time to put the thumb back on the scales, right? So it's so fascinating to watch this, like, because you can recognize like when you transition into these modes, right? It's like you transition from behaving normally. Like if I look back to what we were doing, like, man, August, September, October, like that stuff seems like a dream, man. Like that, in terms of what we were doing, like there was actually not a lot of, for lack of a better term, fuckery afoot. That like there was some, don't get me wrong, it was happening, but it was definitely happening, but in ways that there was a lot more regularity. There was a lot of space between this stuff, and so it seemed to me like a very large. Oh man, August after the Nikkei crash, man, a lot of that was very predictable in terms of what was going on with our options data and our gamma exposure. Late August, early September, basically how earnings played out. October again was also kind of a dream, very flat, but a dream, and then that played out perfectly, into kind of November. this November bull run. And then I would say right now, January, February, things have been all over the place. And you can see when we kind of have these movements in our TA, right? If we shift back up here, right? We have these moments in our alignment where, like, things do not make sense, and then we move into a pretty understandable technical paradigm, and then we get misconfigured, and now we're doing this, and then we're kind of ejected again, and then sort of behave, like sort of track with some kind of macro bearish regression, kind of, but not really. Right? We had a candle go all the way up here. So it's like, this is definitely one of the, I would say this is one of the roughest periods to try to forecast and anticipate what GameStop's price action is going to do. Right? This, again, very regular. We saw this coming, or anybody who is with me back over on the Reddit days, like, you guys remember, we saw this coming. We saw this coming way in advance, right? We saw these IV dynamics way in advance. Little surprise here, but beyond this, right? Even earnings worked out fine. Great predictable movement in our bullish regression channel here. Good stuff until not, and then this, and then not, and then this, and then not, and then not, and then yeah. If somebody asked me the other day, somebody said, like, so what do you think? Like, because I was explaining sort of what I do on a regular basis. They're like, so what do you think, man? Like, is this a buy? Like, do I go do it? And I was like, well, not financial advice, obviously, but maybe yes, but like in these conditions, buyer beware, right? I mean, this is a great opportunity. Personally, right, my conviction is this is a great opportunity, and I love what the company's been doing. I love what I've seen so far this year. Really amazing what they've been able to pull off, what Ryan Cohen's been able to pull off. Love the direction of the company, excited for earnings, all of that stuff, yeah. But in terms of, like, if you're trying to understand price action on a regular basis, like, trial by fire. And I love the way that Richard put this the other day. Richard Newton in his video, right, thinking about this as an opportunity of a lifetime. We were sort of in agreement on this. I talked to him shortly before his video, and yeah, this is the idea here, right? Is there's a moment, right? If you focus, I sort of talked about this on Sunday's live stream too, right? GameStop is a unique point. GameStop is a window into the fabric of how this entire system works. It is idiosyncratic, right? As Richard put it, right? You can see, you don't get to see on other stocks. You don't get to see all of this stuff, all of these tricks get taken out of the bag, and really, like, kind of step by step see how that affects the price or governs what price action looks like on a regular basis. It's why I decided to just GameStop, right? To just focus on this, to just do depth, right? Because we have, right, if you think about this is an infinite, other people have put it this way, GameStop is an infinite black hole into the operations of the market. It stood in 2021 as truly a chance for every major institution to suffer infinite loss based on what had occurred leading up to 2021. And as a result, it is an infinite repository of complexity, of the different orders of magnitude, of the different layers that really truly govern the game of US and global financial markets. I imagine, without directly being an insider into that machine, you'd be hard pressed to get the opportunity to learn something like this, right? I mean, if you don't, like, I imagine, right, if you go to talk to, like, anybody else, like any, I don't know, if you have, like, boomer dads or something who, trade stocks, or, Gen X dads who are just like, yeah, I just picked this up, like, really excited about ChargePoint or something, I don't know. the questions that I would then begin to ask about ChargePoint versus like, GameStop, like where are you in the volatility cycle? Like what's shares available to borrow? Like how often do you see fluctuations in IV of like greater than 50 percentage points in the span of a few weeks? Like, oh, how does this, like you would never even think to ask those questions, right? That's an entire like how many generations of investors or traders like wouldn't even think it was worthwhile to track those metrics, and they're necessary in order to deal with GameStop, right? So yeah, it's an opportunity. It's an opportunity, and the thing about this stuff, right? It's still, even when it does unpredictable things, even when institutions have their thumbs on the scale, um, you know, what goes up must come down. You can't. The trick is, after something disappears, right, making it reappear. That's the real magic. So we'll see, eh? We'll see what the future holds. Definitely, good luck out there, everybody. Right, good luck as always. Definitely, cheers, and we'll see. Yeah, we'll see you tomorrow, bright and early here before market opens. So, cheers, everybody, and thanks.